I'm Grant Walker. Welcome to Last Call for Thursday the 21st of May, and I'll be back with Heads Up Friday morning, 10 a.m. To the budget. The budget targets an additional $240 million a year to low-income families on benefits and in work, but makes new demands of sole parents, including that they be work-ready by the time their youngest child turns 3 rather than 5 years old. Childcare allowances increase slightly to assist with that new expectation, and requirements to work longer part-time hours, but higher entitlements also reduce the level of accommodation supplement support available to both working and beneficiary families. The changes take effect from April 1 next year and will add $25 a week to benefit rates of families with children, the first increase beyond adjustment for inflation in 42 years. Working for families' tax rebates will also increase and are skewed to the lowest income families, with some families with household incomes of more than $88,000 a year set to lose small amounts of their current entitlements. The cost of the measures over the next 4 years is $790 million, with continued annual costs of $240 million. Fact sheets accompanying the budget say beneficiary families who pay income-related rents for social housing will pay slightly more in rent than they otherwise would. Their rent is set at 25% of their income, so a benefit increase of $25 a week means their rent will go up by $6.25 a week. Families on benefits who rent privately would expect to lose around $4 a week in accommodation supplement support. These flow-on effects mean beneficiary families will receive, on average, an in-the-hand income gain of just over $23 a week. Working families earning between $36,350 and $88,000 a year will get up to an additional $12.50 a week through Working for Families tax credits, while 4,000 very low-income families will receive an additional $24.50 a week. About 50,000 families will receive the full $12.50 uplift, with the tax credit changes affecting some 200,000 families and 380,000 children. For families earning more than $88,000 a year, reductions of around $3 a week in WFF payments can be expected, as the increase in the weekly in-work tax credit from $60 to $72.50 is offset by an increase in the abatement rate for the credit from 21.5 cents to 22.5 cents in the dollar. Some 110,000 families and 190,000 children will see increased income through the benefit system changes. Offsetting these increases are an annual evaluation of eligibility for sole parent support, the same as the job seeker benefit, while parents will be required to find part-time work of up to 20 hours a week and to be available for work when their youngest child is 3. Childcare subsidies will rise from $4 to $5 an hour for up to 50 hours of childcare a week. Meanwhile, the government has decided to write off as much as $1.7 billion of outstanding child support payments and penalty fines revenue, reasoning that forgiving past debt will encourage non-compliant parents to meet their obligations in the future. Some $3.2 billion of child support debt is outstanding, of which $2.5 billion is accumulated penalties for late payment and reflected in an overly punitive system, according to Revenue Minister Todd McClay. He said if maximum discretion is applied, this will result in $1.7 billion of penalties being forgiven over 4 years. He said of which $1.6 billion was already recorded in the government's books as an impairment, meaning it's not expected to be recovered. The fiscal impact over the next 4 years is only a reduction of $47.1 million in government revenue. A new 2-stage penalty system will apply in future. To Statistics New Zealand, new figures reveal the number of Asians who call New Zealand home will outnumber Māori living in the country in the not-too-distant future. Statistics New Zealand's ethnic population projections outlines that by 2038 there will be 1% more people who identify with an Asian ethnicity than those who identify as a Māori in New Zealand. The proportion of the population identifying as Māori is projected to grow from 16% in 2013 to 17% in the mid-2020s and to nearly 20% in 2038, while those identifying with an Asian ethnicity will grow from 12% in 2013 to 17% in mid-20s and 21% in 2038. The number of people who identify with a Pacific ethnicity is forecasted to increase from 8% in 2013 to 9% by mid-2020s and up to 11% in 2038. The number of people who identify with a European ethnicity is declining. The data shows the number of Europeans will drop from 75% in 2013 to 70% in the mid-2020 and then 66% in 2038. Statistics New Zealand Population Statistics Manager Vina Cullum says there is considerable overlap of these ethnic populations. Vina Cullum says people can and do identify with multiple ethnicities, especially people aged under 30. She says the different projected growth rates reflect a combination of different patterns of fertility, migration, age structure and ethnic identification. She adds that ethnic projections are of more than just academic interest. She says they inform New Zealanders about our changing demographic picture. They help ethnic communities understand their own changing populations, and they assist planning in areas such as education and health, where different ethnic populations can have different needs. The numbers also show deaths are projected to increase for all ethnic groups, despite assumed lower death rates and increasing life expectancy. This increase reflects more people reaching the older ages where most deaths occur. In 2014, 90% of deaths in New Zealand occurred at ages 55 years and over. More results. Augusta Capital, the listed property investor and fund manager, increased annual earnings by 5% as gains from its funds management business offset a decline in rental income. The Auckland-based company said in a statement, distributable earnings after tax, the preferred measure of property investors which strips out unrealised movements in the value of their portfolios, rose to $4.9 million in the 12 months ended March 31st from $4.6 million a year earlier. Revenue climbed 35% to $18.6 million, with management fees contributing $5.3 million, up from $818,000 a year earlier. Property revenue fell to $6.7 million from $8.1. Net profit soared 422% to $10.4 million, including a $4.4 million unrealised gain in property values and a $1.6 million gain on the sale of property management rights. Last year, Augusta bought property investors KCL Property and Investment Property Titles for a combined $15.4 million in cash and scrip, giving it about 165 properties to manage with some $1.1 billion in funds under management. The company said Augusta has continued to develop its business through diversification of its income from directly owned property to funds management revenue that is not capital demand. Our new scale and funding capacity should allow us to identify quality offers for release, and we will continue to apply a disciplined approach to our assessments. The company expects to continue the improving trend in earnings. The board declared a final dividend of 1.25 cents a share payable on May 15, with a May 8 record date. That takes the annual payout to 4.75 cents, up from 4 cents a year earlier. The shares last traded at 99 cents and have increased 2.1% this year.
NBR Radio. Free to air online with business news you can use.
In the latest major international banking scandal, authorities have imposed fines totaling $5.6 billion US. In his editor's insight on Thursday, Neville Gibson says the fines are among the largest ever in the financial world. Neville, who are these banks and why were they fined?
Well, the 5 banks are among the biggest in the world. 4 of them, JP Morgan Chase, Barclays from England, Royal Bank of Scotland and Citigroup, they've pleaded guilty to conspiring to manipulate prices in the foreign exchange market between US dollars and euros, and that's worth about $500 billion a day as traded. Of course, that's just money going back and forward. The 5th bank is UBS of Switzerland. It's not part of that particular charge on the foreign exchange market. Instead, they've pleaded guilty to manipulating the LIBOR benchmark. That's the London Interbank Offered Rate, and that involves interest rates, the swap between banks, and the total amount of all these fines, as you say, comes to $5.6 billion. On top of that, Citibank also announced overnight that it's paying out some $350 million US dollars to settle a private case brought by investors over foreign exchange losses.
Interesting that they appear to have gone belly up without having to hire a whole swag of very expensive lawyers to defend them.
Well, I'm sure there are plenty of lawyers involved in this, but these are where the authorities got huge powers of discovery, make these out-of-court settlements. This is not from a court trial, and these are not the first that have happened and probably won't be the last.
Well, $5 billion is a lot, but will this hurt the banks?
Financially, probably not. $5 billion is a real drop in the ocean for some of these big banks, but it could lead to more hefty payouts. The legal chatter in London and New York, the lawyers there are rubbing their hands with glee because while the banks have all promised to clean up their acts and they blame it on small groups of traders, the lawyers say the evidence that's come out in the latest settlement open the door for clients, big clients like pension funds, to claim damages for their foreign exchange losses, just as in the Citigroup case that's already been settled. In fact, the one-off sort of nature of Forex trades means that they can actually track them through and as a result of the evidence there. So putting down an open and shut case in foreign exchange is actually quite easy, and these larger institutions are well able to afford the lawyers who can put forward these sort of cases.
So who's carrying out the investigations?
Well, the big boys are involved in this. In the US, it's the Federal Reserve Bank and the Department of Justice. In Britain, it's the Financial Conduct Authority. They get the fine from Barclays, and that's the biggest one in British financial history. And these are certainly among the biggest to date. They show that the bank's systems and controls were pretty seriously wanting, and along with the frontline management and ethical standards. Now, of course, part of the deal with these settlements is that the banks actually give some evidence that they're doing things about it, but there's no doubt that the most interest in these cases is how they suppressed competition in the foreign exchange market.
Well, what sort of manipulation do these banks get up to?
Well, this is really interesting, and you read some of the finer detail. Essentially, the evidence shows that the traders operated chat rooms in a kind of closed community where they revealed positions and their client orders to one another. This is sort of acting like a cartel. In fact, cartel was one of the names of these groups. So they discussed ways to move rates one way or another depending on the positions, but these clubs weren't open to everyone, and one was invited into the chat room for a 1-month trial, and this is according to the transcripts that have been made public, and he was warned, mess this up and sleep with one eye open at night. In another example, traders at one bank used hand signals when they were doing open calls with the clients and customers listening in to conceal what they were really doing.
Interesting. So what do the banks say about these fines? Have any of them spoken up?
Well, one of them has. That's JP Morgan. Mostly they're brushing them off, saying that there's no systemic problem and it's limited, as I said earlier, to a handful of what they call rogue traders. But JP Morgan is blaming almost all of its fine, which was $890 million, on the activities of just one trader. He was hired in 2010. Interestingly, he came across from RBS, one of the other banks that's pleaded guilty, but he was fired in 2014. And in a statement, JP Morgan's boss, Jamie Dimon, says the lesson is that the conduct of a small group of employees or even a single employee can reflect badly on all the staff and have significant ramifications for the entire firm. I'm reading from his statement, and he confirmed that the fines paid to the US authorities in this case all were, quote, principally attributable to a single trader and his coordination with traders at other firms.
Well, thanks very much for today's Editor's Insight, which of course will be the last Editor's Insight from Neville for the next few weeks as he goes off on holiday to the Northern Hemisphere. So do have a great holiday, Neville.
I will. Thanks, John.
NBR Radio. With Hotel de Brett, your home away from home, but with better service. NBR Radio.
To media news, John Campbell is leaving MediaWorks, and the show that bears his name will be replaced with a new current affairs show that will screen 7 p.m. Mondays to Thursday and feature 2 presenters. Meanwhile, a new entertainment show is being developed for the 7 p.m. Friday slot as part of TV3's successful Friday night comedy and entertainment block. Mr. Campbell was reportedly offered one of the co-host roles on the retooled current affairs show, expected to launch in 6 to 8 weeks. But according to Group Head of News Mark Jennings, John has decided he wants to take a break from the job, and we respect his decision. MediaWorks' decision about Campbell Live, made public just minutes after today's budget lock-up finished at 2 p.m, comes after the TV3 Current Affairs program was put into a highly publicised review process 6 weeks ago. In April, the media company, which owns television channels 3 and 4 and radio stations such as The Edge and Radio Live, announced it was exploring ways to improve the commercial performance of the 7 p.m. weekday primetime slot. At the time, Campbell Live's average audience per episode was hovering around 150,000 viewers. As soon as the review was announced, several social media-based campaigns to save the show were started, petitions were signed, protests staged, and commentaries on the future of television written. More importantly, ratings for the show skyrocketed after the advent of the review, with Campbell Live drawing a nightly audience approximately twice the size of its pre-review viewership. That means Campbell Live has consistently been one of TV3's most popular programs for the past 6 weeks and the channel's most watched show for 16 of the past 30 nights. According to a MediaWorks statement, the review was a thorough process that assessed a wide range of options, and an evolution of current affairs at 7 p.m. emerged as the best option for improving commercial performance of the prime time 7 p.m. slot on TV3. Mr. Jennings says the review has clearly shown us what's most relevant to our audience at 7 p.m. as current affairs, but not Campbell Live as we know it. We'll be bringing the best of Campbell Live over to the new show, but we'll be looking at a wider mix of stories. According to Mr. Weldon, the senior management team was unanimous in its decision about the future of Campbell Live and believed the new show was the most relevant option for audiences and advertisers. Mr. Weldon says, I want to pay tribute to John Campbell. He's made a huge contribution to TV3 and MediaWorks over the years, and I was hoping this would continue, which is why last November I offered John a 3-year contract, which he did not sign. I respect John's decision not to continue at MediaWorks and wish him well. Campbell Live celebrated its 10th anniversary on air in April this year. Back to the budget. New Zealand's weak inflation and ACC levy cuts contribute to a 4-year $3.2 billion reduction in the Crown's operating balance in Budget 2015 versus the half-year update, prompting Finance Minister Bill English to axe savings incentives to fund welfare priorities. The operating balance, excluding gains and losses, is forecast to be a deficit of $684 million in the year ending June 30, slightly more than the $572 million deficit projected in December, while the 2016 surplus is whittled back to $176 million from $565 million. While the tax take is revised down, the government has kept future operating allowances unchanged from the half-year update, while announcing new spending such as increased family benefits and childcare as part of a flagship $790 million child hardship package. All up, new operating spending over the next 4 years amounts to $6.1 billion, of which $2 billion is funded through reprioritisation and increased revenue. To help finance that, Mr. English has found $500 million of savings over 4 years from scrapping the $1,000 kickstart payment to people enrolling in KiwiSaver, a levy on cross-border travellers to fund passenger-related biosecurity, and customs services at the border will raise $100 million a year. Mr. English said in Wellington, the overall trajectory has not changed. We're making good progress on the government's fiscal priorities and the outlook is positive. The Treasury is predicting solid growth, growing employment and real wage increases. However, lower inflation means tax revenue is not rising as quickly as expected. Tax revenue over the forecasting horizon is projected to be $4.5 billion lower than had been estimated in the 2014 budget. Compared to the half-year update, nominal gross domestic product is forecast to be cumulative $5 billion lower. The future operating allowances were reiterated at $1 billion for 2016, rising to $2.5 in 2017, that's election year, providing scope for tax cuts if conditions permit, according to Mr. English. For 2018, the allowance is $1.5 billion. Budget 2015 allocates $939 million from the Future Investment Fund, the proceeds of state asset sales for new capital investment. Of that, the government again underwrites the struggling railway, with KiwiRail getting $210 million toward the upkeep of the national rail network. Mr. English said, we imagined 3 or 4 years ago that KiwiRail would not require so much by now. That level of government contribution is unsustainable. The extension of ultra-fast broadband also gets $200 million from the fund, while regional roadways and urban cycleways get $137 million, and Lincoln University receives $100 million to rebuild science facilities. This year's spending leaves the fund with about $700 million to allocate next year before the $4.7 billion of asset sale proceeds are exhausted. Health is the biggest recipient of social services spending in Budget 2015, with an additional $1.7 billion over 4 years, of which the bulk, $1.3 billion, goes to district health boards. Early childhood, primary and secondary education gets an extra $680 million, while a further $305 million is allocated to other social sector initiatives, including an extra $50 million for whānau ora, $59 million for vulnerable children interventions, $32 million to target welfare dependency, and $164 million for frontline policing and crime prevention. Budget 2015 allocates an additional $108 million for the Christchurch rebuild, which will help fund land clearances for so-called anchor projects in the city. Business Growth Agenda funding amounts to $345 million, including $133 million allocated to higher education and $80 million to research and development grants. The Treasury revised its forecast track for GDP, which it now sees as weaker this year and next than it projected in December, before picking up at a faster pace in 2018 and 19. The fiscal impulse, a measure of the impact on aggregate demand in the economy from discretionary changes in the fiscal position, is seen as negative for the 3 years through to 2019. The forecasts are underpinned by a series of key economic assumptions, including migration inflows shrinking back to the long-run average rate of 12,000 a year by 2017, after peaking at 56,600 in the year ending June 30. It also assumes dairy prices recover back to long-term levels forecast by the OECD FAO by the end of 2016, and crude oil, as measured by West Texas Intermediate, rises to US 78 a barrel by the first quarter of 2019. The Treasury sees the TWI holding at around 77.9 until late 2018, before falling back to 76.4 by the June quarter of 2019. The 90-day bank bills are seen rising 1.3 percentage points by 2019, while 10-year bond rates are expected to climb 1.9 percentage points.
NBR Radio, Thursday the 21st. I'm John Stewart. Well, Jade is keeping its eyes on the horizon after it's announced a $1 million loss. It has been bleeding years of red ink in pursuit of its growth overseas. To bring us up to date on developments with Jade, I'm joined by Tim Hunter. So what's happening there, Tim?
Yeah, well, Jade Software has just announced its annual result for the 2014 year. And it's a $1 million loss on revenue of about $30 million. And one of the interesting things here is that Jade is reporting its results at all. Jade is a private company and doesn't have to make its results public.
No.
Or at least it doesn't have to kind of come out and discuss them with us. But it's interesting because Jade has a very long history as a flag bearer of the New Zealand software industry, and its co-founder Sir Gill Simpson was very well known as a pioneer in the software sector in New Zealand, and Jade is really one of those names that everyone follows, really for that reason. It's a different company now than it was, but and they made quite a bit of money in 2013 from the sale of Wynyard Group, their crime-fighting software business that they set up. So that actually was a very great success story for them and for the New Zealand market.
Who did they sell that to?
Wynyard was sold in an IPO.
Right. Okay.
So it's now floated on the NZX, and it's been doing pretty well, and it's quite a sexy business itself. The current Jade business, it is, I guess, for the layman at least, two sides to it. One is a business that makes and sells software systems that help port operations handle their logistics and their freight management. And that's been doing very well in the last year, with revenue up 56% over the previous year.
That's pretty healthy, isn't it?
It is. It's very good, and it's obviously a sector in which they've carved themselves a very useful niche. And the other side of their business is really one for the software geeks. They're developing bespoke software solutions for corporates and new software products themselves, and they've got one quite interesting one in the pipeline at the moment that's being piloted in Sydney.
Oh yeah, what's that?
This is a wealth management software product, and the way they've described it is it's a sort of it's software that can be run on a mobile phone, on a smartphone. It allows wealth management clients to see all their portfolios and see all their specialist financial advice from their advisors, and also transact in real time over the phone. And I gather that's being piloted by a wealth management firm in Australia at the moment, which looks to me like it has considerable potential.
So, as far as Jade is concerned, and its $1 million loss, they're saying so. What did you expect? Is that a fair summary?
Well, it's basically they've improved their bottom line on the previous year, which I think was in continuing operations about a $7 million loss. But the longer-term story here is that they expect to be profitable in about 3 years' time, and they've been investing heavily in developing their ongoing business. And so the idea is that in a few years the profits really will roll in for them, and so they're kind of looking at the long term, and they've got supportive shareholders who are prepared to hold on and not get too alarmed by a little bit of a short-term loss.
Thanks very much for that, Tim.
NBR Radio. Free to air online. NBR, the meeting place of intelligent business.
This is the 2015 Budget Special on NBR Radio. In Wellington, our political editor Rob Hosking, who's just come out of the budget lockup in the Beehive, and in our Auckland studio, Nick Grant.
This is Nick Grant for NBR Radio. I'm talking to economics and political editor Rob Hosking, who's just come out of the 2015 budget lockup. So, Rob, I can only but imagine that you were like a kid on Christmas Day when you get presented with all those cabinet briefing notes. But for the budget, what's the thing that's really stood out for you in an economic sense about this year's budget?
Economically, I expected them to screw down the forecasts a bit more. And I really am surprised they didn't. And look, I know that, and a lot of people don't realise this, but the forecasts are not done by the government offices, by the minister's offices. They are actually done by the Treasury. So they're sort of quasi-independent. I wouldn't overstress the independence, but at the same time, I wouldn't overstress, as a lot of people do. They tend to presume they come from the minister's own projections. Finance ministers don't work this out themselves with an amicus or something. The work's done by Treasury. I did think that they might be tempted to just take a little bit more of a conservative approach. But those economic growth forecasts are assuming 2.8% growth on average every year over the next 4 years. That comes off the current peak. The most recent year we had was 3.5%, but that's still at or slightly above the long, what is assumed as being our long-term ability of our economy to grow. So that was a bit of a surprise. The other thing is, I thought they might really screw down some of those tax forecasts after some of the sort of revenue surprises the last year or so. They haven't done that. There's a little bit of a down for this year, but not so much for the out years. They're still assuming between 5 and 6% growth in tax revenue. That is below what we've had. What a lot of people don't realise is, even though they've missed the forecast, tax revenue has been running quite, the most recent annualised figure was 12% for company tax growth, for example. I think overall it's been around 7 or 8%. We've seen those sorts of figures each year in tax growth, which is quite a bit above GDP. So I did think that now that we're moving into this low inflation or no inflation at the moment and low interest rate environment, they might screw those forecasts down a bit more, but they haven't. So that was probably on the economic side. That was some of the more surprising stuff.
What about the political aspects of the budget?
Well, this is where things get quite interesting in a way, because it's very... you've sort of got that area which is a mix of politics and economics, which is the KiwiSaver stuff, which is quite small in the greater scheme of things, but they've taken away the $1,000 kickstart, which is probably going to annoy quite a few people, I think. Even though in dollar terms, it's most people who want to be in KiwiSaver have joined. What I found interesting is they are still committed in that area, though this isn't in the budget, but it was something English said during the lockup, to encouraging more people into KiwiSaver at some point down the track by basically getting them, auto-enrolling them, giving the option of opting out. So it's a sort of soft compulsion, if you like. That was National's policy the last two elections, although they haven't done it yet. And that is a bit expensive for the government, because even though there's the kickstart and they've got rid of that now, there is still the tax credits you get for it, and that's actually the more expensive bit now. So I thought, it did look as if, okay, well, maybe they're abandoning it. But no, they are actually going to still do that at some stage. The big one, of course, is that $790 million figure on what they're calling the hardship package. This is the first increase in real terms to benefit levels since 1972, which is quite a long time ago.
Yeah.
And one of the more socialistic leaning colleagues jokingly dubbed it the Bludgers budget as we were leaving the Beehive today, which is, he's being a bit jokey there. Politically, what's going on here is one of the things that has really had an effect on National Party MPs right through the caucus and in the wider National Party, going back to the election and beyond, that there's been a growing concern even in national supporters that, the economy's actually doing quite well, but there are people getting left behind. And, leaving politics and ideology aside, there is that sort of Kiwi thing that, you kind of don't like seeing that. So this is quite interesting. But the other interesting aspect of it is very much a carrot and stick approach, because they're encouraging people off benefits and getting into work, and so as well as additional benefits, there's going to be additional responsibilities and expectations, which is a very sort of classical conservative approach, I guess.
So the political management that went on prior to the budget, that's what it was, presumably, hosing down expectations that there would be anything to, particularly to address child poverty, or is this not really geared towards child poverty per se?
Look, of course there was quite a bit of political management. I think there seems to have been a feeling that, National could do this without, hosing off its own supporters, and at the same time, I think they've effectively trolled the opposition, which it seems to be a long-standing political tactic of the current government. And John Key is he trolls the whole time. He baits the opposition parties and the Labour and Green activists into overreacting to things and coming out with incredibly inflated stuff, and then delivering something completely different, and it leaves them looking like unreasonable, like the unreasonable ones. And I think they've done it again. Earlier in the week they were saying, well, there's no new. And again, this is careful use of words and watching what people use for words. There was only yesterday. There was there are no new programs, I think was the term used, or something like that in the budget, which to address child poverty or anything like that. Well, there aren't. They've just increased the spending on the existing ones. And if people had listened more carefully, to me, taking a step back, there was no way they were not going to have something in this sort of hardship welfare area, because there was just such a strong feeling that something there should happen, and if they didn't do something, then they were asking for a political kicking. So I just simply didn't. I looked very closely at the words that ministers were using this week, and it didn't seem to me that if you looked at the words that were being said, they were not saying what people were interpreting them as saying. And there was quite a big overreaction to some of that stuff. And who's looking silly? Again, it's political management by trolling. And this government is very practiced at it.
Well, we must let you get back to knocking out some in-depth analysis about the budget, which will be going up on nbr.co.nz. But in the meantime, Rob, just a quick gut reaction. How do you rate the budget overall? Is it visionary, steady as she goes, a bit disappointing?
Surprisingly, I hate the word visionary.
Okay. Substitute the one that you prefer.
To me, visions, things people, who take peyote see. This actually, under the hood, there's some longer term stuff going on here. Some of that welfare stuff, it's not just about increased spending. And, the social services budget is still 75% of government spending. Don't forget that. And this is, a way of, they're looking at ways of managing that better. And the other hint, which English delivered in there, is that there'll be more use of, third sector community groups to deliver social services, and probably some restructuring as well to save some money down the track. It's a stronger budget than I expected. I'd say it's quite strong, I'd put it that way. And it's balanced politically, even if it's not quite balanced economically just yet.
Rob Hosking, thank you very much.
That was our 2015 budget special on NBR Radio with our political editor Rob Hosking in Wellington and Nick Grant in our Auckland studio.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.
To banking, Heartland New Zealand, the bank formed through the merger of Canterbury and Southern Cross Building Societies with Marek Finance, says it expects full-year profit to be at the upper end of its guidance range. The Christchurch-based lender expects profit to be at the top end of its 46 to 48 million range in the 12 months ending June 30, 2015, compared to a profit of 36 million in the 2014 year, it said in a statement. It said unaudited net profit for the company's Heartland Bank unit was 30.9 million for the 9 months ended 31st March 2015, compared with net profit for Heartland New Zealand of 36.1 million, primarily due to the portion of Heartland's reverse mortgage book that is held outside Heartland Bank. The lender is targeting expansion through niche markets, particularly in the consumer finance sector. Last year, it bought the reverse mortgage business from Seniors Money, and it's also taken a 10% stake in peer-to-peer lender Harmony Corp for $3.5 million to accelerate growth. The lender estimates its stake in Harmony is now worth $5 million. Some $17 million has been lent through the online platform. Shares of Heartland were unchanged at $1.29 and have gained 14% since the start of the year. As we continue our budget coverage, the New Zealand Debt Management Office will increase borrowing by an extra $1 billion in the 2016 financial year, a period where the Treasury anticipates a bigger cash deficit as capital spending is expected to exceed cash flows. The DMO will issue $37 billion of bonds between 2014-15 and 18-19 financial years for a net issuance of $4.3 billion, it said in a statement. That includes an extra $1 billion in the 2015-16 year, when the office will raise $8 billion and repay $1.2 billion of maturing debt for a net issuance of $6.8 billion. That will help cover a spike in the government's forecast residual cash deficit of $4.2 billion in the 2016 year, up from a shortfall of $2.7 billion in 2015 and higher than the December forecast of $3.5 billion. The Treasury pushed out the expected return to cash surplus into the 2019 year, when it sees a positive balance of $1.7 billion. The government's capital spending program of $23.4 billion over the next 4 years on physical assets such as school buildings, advances such as student loans, and to provide funds for capital expenditure is expected to exceed operating cash flows, peaking in the 2016 year at $6.2 billion. The cash shortfall of $6.9 billion over the period will be funded through additional borrowing and in reductions of financial assets, according to the Treasury. The DMO's program includes a new April 14, 2033 nominal bond expected to be launched through a syndicate in the first half of the 2016 year, while an inflation-indexed bond of up to $2 billion will also be issued that year. Treasury bills are expected to average $4 billion over the forecast period. The Treasury sees lower net Crown debt at $61.7 billion, or 25% of GDP in 2015, before peaking in nominal terms at $67.2 billion, or 24.4% of GDP in 2018.
NBR Radio, Thursday the 21st, I'm John Stewart. Cavaliers chairman has said the company's bank, Bank of New Zealand, will have almost infinite patience with the company as it struggles to turn itself around. Jenny Ruth has been talking to the company and she joins me now. Jenny, is it usual for banks to be as accommodating as Cavalier is suggesting?
Well, no, not at all.
No.
Banks are certainly not known for their patience, and particularly when a company's in as sticky a position as Cavalier is currently. A few years ago, if you were looking forward, you would have expected Cavalier would be flourishing now. The New Zealand economy has been strong for years, and although the Australian economy hit a weak patch, it still actually grew, and its housing market's been very strong lately. Yes, the New Zealand dollar's been very, very strong, but Cavalier should still be selling plenty of carpet in this environment. Instead, it's struggling to even turn a profit, and it's going to report another loss this financial year after asset write-downs, and is expected to barely break even next year before returning to what it calls adequate profits the year after that. Now, when you owe your bank more than $59 million and the share market values your equity at less than $25 million, that's starting to look a bit desperate.
Indeed it is.
However, Cavaliers chairman Alan James says the Bank of New Zealand will give his company as long as it takes, unquote, to achieve a turnaround.
Just a bit of a left field question, Jenny, but I just wonder if Cavalier is caught up in this competition between wool and synthetic fibres.
Absolutely. It used to be, not so many years ago, that about 80% of the carpet sold in this country was wool and the rest synthetic. That's completely turned around. It's losing the battle to keep wool carpets as the premium product that everyone wants.
So what do we know about how the company is going to achieve this turnaround?
Well, not nearly enough. The company says it's got a 3-year strategic plan and that it will reduce debt substantially in the next financial year, but it's provided scant details of how this is going to happen. And its plans that we know about so far haven't been unfolding as they hoped. For example, they moved their Onterra carpet tiles business away from just manufacturing its own products to bringing in substantial imports. But it says that this transition is taking much longer than expected. Now, I asked Mr. James the likelihood that Cavalier is going to face further hitches and whether it could well take much longer than the current company's currently projecting to achieve the kind of results he hopes they're going to. He wouldn't be drawn on that.
Thanks very much for that, Jenny.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
NBR Radio. Thursday the 21st, I'm John Stewart. And it's time for our weekly look at the media with Media Watch. I'm joined in the studio by Nick Grant and Campbell Gibson. Nick, first to you, what's been happening at MediaWorks just lately?
The X Factor, one of their second major reality/event show to finish this year, that wound up on Monday. Drawing an audience of 326,000 viewers. Now, I mean, that seems pretty impressive, but it's over 200,000 viewers down on the last season finale, which was back in 2013. TV3/MediaWorks is, of course, talking up the show as a great success and as an example of the wisdom of its strategy to really lean on these kind of entertainment reality shows. Whether it has actually been a great commercial property for them or not remains to be seen.
Indeed. Now, Campbell, just switching to you and the subject of Facebook and their instant articles. Can you tell us what this is about?
Yeah, sure. So Facebook has started a new initiative in the United States with about 9 large publishers, 3 of which include National Geographic, New York Times and BuzzFeed. It's started this new thing called Instant Articles. So instead of where you see an article pop up in your Facebook news feed and clicking on it and taking up to 8 seconds to load this article and being taken out of Facebook, Instant Articles allows you to view the article inside of Facebook. So it's realised that in this very mobile world we live in, people don't have much patience for internet pages loading for very long. So Instant Articles promises to be sort of a more interactive user experience. They can, for example, embed photos and videos inside the articles, which makes it far more sort of interactive and natural, I guess. And load times are said to be about 10 times faster, so it eliminates that problem as well. I've spoken to a few publishers here about it. Fairfax was pretty coy. They said that they're watching it with interest, so they didn't budge much there. And then on the NZME or the New Zealand Herald side of things, they said they're open to the concept, and what they've done with Facebook so far has been very successful. So it's probably going to take, possibly quite a while to arrive here, but I imagine, the fact that so many publishers get a lot of their traffic nowadays from social media sites, that they're going to be very, very interested in seeing how it actually develops overseas and, learning from, the experiences that those publishers have.
Interesting that Fairfax was so non-committal.
Yeah, they're very huge on the social media side of thing, and it's just what you get sometimes. But on that, actually, the revenue model for publishers sounds quite promising. If the publishers sell the ads through Facebook Instant Articles, they get 100% of the revenue. But if Facebook sells the ads, publishers still get 70%, and then Facebook takes 30%. So it actually sounds like a pretty compelling revenue model, and it could be maybe the future of social media and media publishers working closer together.
Now, Nick, you've been taking a look at Radio New Zealand's online service. A few changes there?
Yeah, some interesting moves being made at Radio New Zealand. I mean, it's very much in keeping with what ex-Fairfax head Paul Thompson signalled when he took over as chief executive in the latter half of 2013. At the time, he signalled he was very focused on essentially dragging the radio broadcaster into the 21st century and offering content on other platforms, particularly via the web. So this week, Radio New Zealand has been advertising for 5 more digital positions, if you like, which is a website editor, digital reporters, and so on. So that'll be significantly upping their ability to provide original content to that site. I mean, in recent times, it used to be the case that the site was essentially the repository for podcasts of shows already broadcast via radio, and short text summaries of said stories. But increasingly, there's original written content on the sites and even video content. So this is kind of a great leap forward for the broadcaster, I think.
Maybe with that video content, we're taking a tentative step into a public broadcaster becoming a public television service.
Well, it's something that has been floated a few times over the years.
Yeah.
Though, I'm not entirely sure how practical it is. I think we just have to look at the Paul Henry show to see how difficult it is to strike a balance between kind of like the visual presentation of a TV-based show versus a completely oral program.
Yeah, and I mean, if they're going out like our current news services do on 1 and 3 to actually film stories which are packaged by a reporter, that becomes pretty expensive.
Yeah, absolutely. And it also, I think, has a real effect on the kind of content that you end up broadcasting, because you'll note that a lot of TV news exists because there's dramatic footage to go with it, as opposed to its news value per se, which would, I think, would be a real culture shift at Radio New Zealand. Which
it would be huge. Yeah. Now, Campbell, an outfit called the IAB, and I'll get you to explain who they are discussing native advertising. Can you just tell us a bit more about that and who the IAB are?
Yeah, sure. So the Interactive Advertising Bureau is basically an organisation that looks at the progress of digital advertising, and they're based, they're all over the world. But the New Zealand version of IAB is actually looking at guidelines and standards for native advertising, and there's a big question over what native advertising actually is, and the United States IAB actually found there was about 6 different types. So
really?
It's quite a broad catch-all term that hasn't really been defined. Like, I'll take a couple of examples. So if you're scrolling through listings on TradeMe, you may see that there may be an ad for another listing, and that's highlighted as an ad. That's defined as a native ad. But then it can be something like a news publisher accepts money from a commercial partner to publish a story on their behalf. That is also a native ad. So there's an awful lot of murky waters in what defines native advertising.
Well, if there is one in a newspaper, are they putting advertorial or native advertising?
Depends
at the
who
top
you
of the
ask.
page? Really?
Yeah, they have very different ways of actually displaying it, and some of them don't even disclose it, or they make a very big effort to make it a very fine print, in partnership with X and Y.
Yeah.
And the IAB is now trying to enforce, but recommend standards to New Zealand publishers like Fairfax, NZME, Yahoo, and even Facebook and Twitter to try and get them to, have better guidelines around this sort of thing and disclose things a little bit more clearly.
And NBR, of course.
I guess
Let's not forget we are publishers
exactly.
too.
Yeah.
I have to say, I find it bizarre that publishers are having to have it pointed out to them by a different body that that they need to protect their credibility by labelling this content clearly. It's
Good point.
Crazy.
Good point, Nick. Well, gentlemen, thank you both very much, Campbell Gibson and Nick Grant, for this week's Media Watch.
NBR Radio with the Property Press. It's out now to show you around.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. No surprise, the budget. We look at what's been announced and we also discuss it too in detail on NBR Radio. Campbell Live is axed. Chinese tourist numbers hit a record, as does migration. Dean Barker joins Japan's America's Cup Challenge and more business results are released. To find out more on those stories, just log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio. In business news, Intueri Education Group, New Zealand's largest private training college, expects annual earnings will be at the bottom end of guidance based on current trading performance, having missed prospectus targets in calendar 2014. The Auckland-based company said it sees similar operating conditions as advised in February and that the current performance is tracking to the lower end of its guidance for 2015 earnings before interest, tax, depreciation and amortisation of between 30 to 33 million. It missed 2014 earnings guidance in part because of a slower than expected recovery in Christchurch following the 2010 and 11 earthquakes. Chief Executive Rob Facer said in a statement, against a backdrop of New Zealand's growing reputation as a destination for international students, a strong New Zealand domestic economy underpinning record high labour market participation rates, and a number of significant but welcome regulatory reforms in Australia, we've made solid progress in the 2015 financial year so far. We continue to maintain our focus on improving quality and compliance, integrating the acquired colleges, and exploring further complementary acquisitions in both New Zealand and Australia. The company held its annual meeting in Auckland today, its first since the IPO last year. The shares last traded at $2.08, down from the $2.35 listing price in May last year. Presentation slides for the annual meeting published on the NZX show the company has held a number of discussions over potential acquisitions and says sector consolidation is gaining momentum. Auckland-based Academic Colleges Group, which bought the UB School of Design from the now-defunct Renaissance Corp, this month confirmed it has appointed advisors to review strategic alternatives after it was reported to have been up for sale. Intueri today said an independent investigation by Ernst & Young into the record-keeping of its dive school has ended and the Tertiary Education Commission won't take the matter further. The dive school currently faces charges brought by WorkSafe over the death of a foreign student, and while Intueri has pleaded not guilty, it's in discussions with the government agency to seek a resolution before the next court date on June 18. The company said net debt rose to $35 million as a result of recent acquisitions and the payment of the 2014 dividend, and is forecast to stay between $30 million and $40 million for the rest of 2015. To the budget and KiwiRail. State-owned rail operator KiwiRail takes the lion's share of $249 million additional transport funding over the next 4 years, with an extra $209.8 million available for the year ahead and $190 million in the 2016-17 fiscal year. But the extra funds come with a warning. Transport Minister Simon Bridges said in a statement, KiwiRail must continue to drive sufficient efficiency and productivity improvements to reduce an ongoing level of Crown funding required. Finance Minister Bill English says in his budget speech that support at recent levels for KiwiRail is unsustainable, with funding coming from the Future Investment Fund created by the partial sale of government electricity companies and a reduced holding in Air New Zealand. Mr Bridges said KiwiRail is integral to New Zealand's land transport system. This funding will allow it to deliver services and maintain the national network to a safe and reliable standard. Once next year's allocation is spent, total capital injections to KiwiRail since the 2010 budget will have totalised $1.43 billion. Meanwhile, free travel for pensioners under the Super Gold card will expand, with funding rising by $10.2 million in 2015-16 to total $28.1 million. Briefing journalist Mr English said the government had hoped before now not to be giving such high levels of support to KiwiRail.
NBR Radio, Thursday the 21st. I'm John Stewart. The government's plan to build thousands of new affordable Auckland homes at pace on Crown land is unlikely. I'm joined by our property expert, Sally Lindsay. Sally, just to recap, just what were the Crown's plans that were announced yesterday?
Well, they were announced inadvertently through the Ministry of Business
yes.
on their website. But basically, the government is looking at 430 hectares of Crown land that it will develop in preferred partnerships with private developers to put up affordable housing as quickly as possible. The land will come from universities, the Defence Force, Housing New Zealand and Conservation blocks that are not being used or are wasted, and the MBIE is going through a process now of identifying this land, and Nick Smith is hoping that this will provide thousands of new houses for Aucklanders.
Emphasis on the word hoping.
Yes.
So you've talked to one firm of developers who already have a scheme underway, and there's a bit of a lengthy time gap before they can really get going. That's Veranda. What did they have to say?
Veranda Group have got 115 hectares at Flatbush, which was a farm, and they bought that in August last year for a group of Chinese New Zealand investors, and they're managing the development of this land now. It will have 1,500 sections, and they filed for rezoning consent in December, and they're not expecting to get it through till September. Then they have to do the earthworks, put on all the infrastructure and all of that stuff before even any sections can be released. So that won't be till next year. And then after that, it takes a few months for housing companies to go in there and start building. So it actually is going to be about 18 months before anything even happens on the land. So unless the government's land has already got residential rezoning, which in most cases it's unlikely to have, it's going to have to go through the same consenting process. So in reality, there is not going to be any new homes for at least 18 months to 2 years.
And meantime, rents, of course, continue to go north.
Rents and prices, though the government is apparently offering a sweetener, and they apparently will let developers build and develop the land and then pay them after the houses are being sold. But it's still, and that takes the risk away for developers, but not for the government, of course. But it's still a long process. And Nick Smith's enthusiasm is great, but the reality is actually quite different.
He's always enthusiastic, actually, Sally. Now, there's a meeting for developers here in Auckland, I presume, on June the 1st. To find out what the rules will be about how they tender for land and so on. Do you expect a fair bit of scepticism from them to be levelled at the government?
Oh, I think there will be. I expect a lot of developers will turn up because this is just an initial meeting so the government can lay out the rules for it. After that, developers will have to tender to become a preferred partner with the Crown to develop these sites, and I expect that there will be onerous tender documents to be produced and all that sort of stuff. But it'll be interesting to actually see how this does work, because Nick Smith has had a spat with the Auckland Council over this sort of stuff, but and this is his response in some ways. He just wants to get on with building houses.
Absolutely. Thanks very much for that, Sally.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
To the Human Rights Tribunal, they have ordered Orcon to pay a soldier $25,000 for a Privacy Act breach. Orcon, part of the Corplus Group, set Baycorp on to Brett Taylor, alleging he owed it $208.52. Mr. Taylor said this had an immediate impact on his credit rating, making it difficult to find rental accommodation as he and his family were frequently shifted between army bases. It also damaged his previously good relationship with GE Money, which closed off his credit. The soldier said Orcon set him up with the wrong account in early 2012 and that staff ridiculed him when he asked to speak to a manager. It was not until October 2013 that Orcon finally conceded it had billed Mr. Taylor incorrectly. Privacy Commissioner John Edwards told NBR Radio, if there is a debt in dispute, companies have a very high duty to check because there can be profound consequences for the individual if they get it wrong. He went on, here we have a soldier with a young family who was unable to gain rental accommodation as a result of this particular failure. There's simply no excuse for companies to be as ignorant of the Privacy Act as Orcon was found to be. He adds, if companies want to avoid similar failures, we urge them to use our newly launched online privacy training resource, which is free to use as a way of educating employees about the Act and the company's obligations and responsibilities with the personal information it holds. The tribunal ordered Orcon to pay $10,000 to Mr. Taylor for loss of benefit or the financial harm caused by his incorrect credit rating. The tribunal noted his bad credit rating could still show up on reports for up to 5 years despite being corrected by Orcon. The soldier was awarded a further $15,000 for humiliation, loss of dignity and injury to feelings. Orcon was also ordered to undertake Privacy Act training for staff with the Office of the Privacy Commissioner at its own cost. To the budget and travel. Tourists and travellers arriving in New Zealand will face a $16 per head new border clearance levy from the beginning of next year. This is to deal with fast-growing $100 million cost and demands on customs and quarantine services. A $6 departure fee is also mooted under changes that will see travellers rather than taxpayers picking up the cost of arriving and departing the country. Primary Industries and Customs Ministers Nathan Guy and Nikki Wagner say the government considers it fairer for the costs to fall on passengers travelling internationally. Arriving air passenger volumes have grown by more than 18% from 4.4 million in 2009 to 5.2 million in 2014 and are expected to continue growing at around 3.5% each year. The ministers say the levy will ensure our border processes stay fit for purpose into the future. Cargo clearance costs are already covered by fees. The all-up $36 charge for a return journey compares with Australian charges of around $58 and British charges worth $142. Also announced was a $24.9 million boost to operating funding and $2 million in capital expenditure for biosecurity services to improve import health standards, more auditing of other countries' biosecurity systems, more detector dogs at the border, and more X-ray machines to speed up passenger clearance. An additional $4.7 million will be committed to fund more border security officers over the next 4 years.
NBR Radio, Thursday the 21st. I'm John Stewart. Westland Milk Products, which is based in Hokitika, has registered a marketing arm in China. I'm joined by our Christchurch reporter, Chris Hutching, to tell us a bit more about this company, or co-op, I believe it to be. So, just for a bit of context, Chris, who are Westland?
Right, well, Westland is an independent dairy cooperative. They voted around about 2001, I think it was, to steer clear of Fonterra, because at that time, you may recall that they were putting all of these dairy companies together into one big giant conglomerate, which is now known as Fonterra.
Yep.
And the people on the West Coast thought, well, no, we can't see a commonality there, so we're going to go alone. So they're the second largest milk processing company. But if we put this in perspective, Fonterra has got about 10,500 suppliers. Westland has got about 450 odd, a little bit less than that. In terms of revenue, Fonterra is up around $20 billion a year. Westland is approaching around about $1 billion. But there have been some benefits for Westland in going it alone. It's got a higher forecast payout to its suppliers this year of between 540 and 580. So that's 540 to 580.
That's quite a bit more than Fonterra's projected.
Indeed.
Payout. Yeah.
That's right, John. And Fonterra's looking at about 450 to 470 odd. So, there's a dollar odd difference there.
Yeah. Mm. So what are their plans for China, Chris?
Well, it's quite exciting stuff. They're trying to get into, or they are, into this value-added area. Now, for a long time, the dairy industry here in New Zealand has been criticised for sending over milk powder and not much else. So it's a price taker on a commodities market. So this is why we get these huge fluctuations in milk payouts. Now, Westland, along with the other companies, has been trying to change that gradually. Westland is stepping up to the mark at the moment with a couple of initiatives. For example, they've got a UHT milk factory under construction at Rolleston. That's the milk that you can keep and it doesn't go off.
Right.
So that's going to be part of it, but the other stuff they're concentrating on is their infant nutrition product called Westpro, I think it's called, and a toddler nutrition ingredient powder. So
there's also some sort of make-your-own yogurt product, isn't there?
Yep. That's called Easy Yo, make-at-home yogurt, which is quite popular. My wife's got into that a bit. Right. So these are the sorts of products that they're talking about getting going, selling direct up there.
Now, Greg Wafflebaker is the Westland representative in Shanghai. How's he setting up that office? He's employing locals? He's the only Westerner there?
Yes, that's right. Greg's been on the job for quite a while now, about a year, and he's getting some traction. He went up there on his own, and he now employs about 10 people. They're all local people. One woman, he told me, has lived in New Zealand, but I think she's a native from that area. Right. So he's got people that can speak in both English and the Chinese languages there. Greg himself, I asked him, I said, can you speak Chinese language yourself, Greg? And he said, no, I'm having daily lessons though, and I'm slowly getting the hang of it.
Good on him. Well, he's got a job ahead of him there. We'll have to wrap it up there, Chris, but thanks very much for that insight into this West Coast milk company.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
To tourism, Chinese tourists visiting New Zealand rose to an annual record in April, helping push total visitor arrivals to a new high. Visitor numbers from China rose 26% to a record 302,128 in the year through April. Statistics New Zealand said in a statement. Total annual visitor arrivals increased 6.7% to 2.96 million. China is expected to overtake Australia as the biggest tourism market in expenditure terms within 7 years, although Australia will likely to continue to be the largest source for tourists, according to forecasts published this week by the Ministry of Business, Innovation and Employment. The data published today showed Australian tourism numbers increased 3% to 1.27 million in the year through April, more than 4 times the number of Chinese visitors. MBIE expects Australian tourism numbers to increase at a 3% annual rate over the next 7 years, compared with China's 11.6% gain. Tourism New Zealand Chief Executive Kevin Bowler said that China continues to see impressive growth. Most of the latest increase in Chinese visitors came from holidaymakers, the agency said. Chinese holidaymakers increased 27% to 225,680 in the year through April, while the total number of visitors who came to New Zealand for a vacation rose 9.7% to 1.44 million. Holidaymakers and those visiting friends and relatives are counted on as the biggest drivers of an expected 48% growth of international tourist spending by 2021 to 1.11 billion, according to the MBIE forecast released during New Zealand's annual Trends Tourism Conference in Rotorua this week. According to Chinese travel agencies at the Trends Conference, New Zealand has transformed itself from a drop-by place for Chinese tourists on their way to Australia into a destination worth repeated visits. Following that trend is a shift in Chinese tourist tastes from package tours to free independent travelling and more in-depth experience. Tourism New Zealand said holiday arrivals had also increased visitors from New Zealand's other Asian target markets. In the year through April, holiday arrivals from Japan were up 19.5%, Korea 19.5%, Singapore 12%, Malaysia 15.9% and Thailand 17.6%. In business news, Cavaliers chairman says the Carpet Makers Bank will give it as long as it takes to turn the struggling company around. Alan James told NBR Radio as long as they understand what we're facing and what we're doing, they have almost infinite patience. Mr James wouldn't comment on the likelihood of further hitches in Cavalier's recovery plans or that they will take longer than currently projected to achieve results. He says the company has faced and continues to face incredibly challenging circumstances. I'm sure the current plan will restore the company's fortunes to an adequate level of profitability. Yesterday, Cavalier announced its sixth successive profit downgrade, forecast a bottom-line loss because of asset write-downs, and that its managing director had resigned. Cavalier is now warning investors to expect a normalised annual profit at or below $1 million, down from the previous guidance of between $1 and $4 million. But the bottom line will be a loss after further yet-to-be-quantified asset write-downs compared with a net profit of $5.8 million in the year ended June 2014. The company said it's prepared an undated strategy and business plan, which has been reviewed by accounting firm Deloitte and which has been laid before Cavalier's Bank of New Zealand. Managing Director Colin McKenzie has been replaced for a 6-month term by Paul Alston, the former Chief Financial Officer. Mr James says Mr Alston is a very competent and seasoned executive. We think he's very qualified to take on the chief executive role. In due course, we may put him up against other candidates we can identify, and he may well come through that as the best candidate anyway. Cavalier blamed the latest delay to its long-promised turnaround on a slower-than-expected transition for its Onterra tile business to supplementing its manufacturing with substantial imports and on the strong New Zealand dollar hurting its Australian broadloom carpet operations. It's now forecasting an improved result coupled with substantial debt reduction in the year ending June 2016 and a return to adequate levels of profitability the following year. In housing news, the government's plan to build thousands of new affordable Auckland homes at pace on Crown land is unlikely. Housing Minister Dr Nick Smith says the government will open up millions of dollars of land for private developers to quickly build new homes. But some developers are sceptical, saying consenting requirements will prevent any houses popping out of the ground within 18 months and possibly longer, and anything can happen to the market in that time. Many of the Crown's housing sites for development and sale will come from land held by tertiary institutions, health boards, the Defence Force, Housing New Zealand and the Conservation Department that has never been used. But unless the land is already zoned residential, it's unlikely work on new homes will start quickly. Dr Smith, in a spat with the Auckland Council a couple of weeks ago over its refusal to give special housing area status to 3 Huapai blocks until the government stumped up with roading infrastructure funding, said he would open up housing land and give it SHA status. Even with SHA status, any private developer with Crown land will have to go through the Council's resource consent process for rezoning and other consents. This can take up to a year or longer, even under the speeded-up process. Veranda Group, which is managing the development of 115 hectares of rural SHA land into 1,500 sections of Flatbush, expects it will not be given residential zoning across the block until September at the earliest. It bought the block last August, and it will be next year before any sites are released to the market, and a few months after that until houses start rising. The company applied for rezoning consent in December. Managing Director Mark Bridgman says even though the consenting is a much quicker process, it still takes time. It will be doubtful much of the Crown's land will have residential zoning, he said, and it's hard to assess how the government's plans will affect the market. There is no doubt a burgeoning housing shortage is putting strain on the market and prices are soaring, but new homes are not going to pop up quickly. Markets can also easily change within a year, although it would have to be a major outside factor to have a big effect. The budget plan was revealed by the Ministry of Business when it put out an invitation yesterday asking private developers to attend the launch program of work to develop housing on 430 hectares of Crown land. The government is expecting thousands of houses to be built by private companies it will select as preferred partners through a tender process. The private development companies will not have to pay up front, instead paying the government a fair price once the houses are sold.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
This is Nick Grant with Campbell Gibson for a special edition of Media Watch on the occasion of the announcement of the fate of Campbell Live. At 2 p.m. on Thursday, the 21st of May, it was announced that John Campbell is leaving the show that has borne his name for the past 10 years, and that show will be replaced by a new current affairs show that will screen 7 p.m. Mondays to Thursdays and feature 2 presenters. Now, I guess the first thing to comment on is the incredible cynicism and ineptitude of releasing the news at exactly the moment that the budget lockout was finished with the hope, presumably, on the part of MediaWorks management that that the announcement would be lost in the flood of budget news. This kind of use of the news cycle is something that absolutely enrages journalists, and I guess it's just a demonstration, Campbell, of just how unaligned senior MediaWorks management are these days with news and current affairs values.
Yeah, I think we're all kind of predicting that it would come along with the budget. It was one of those things, obviously, that they want to bury down as far as they can, but I think they're probably going to underestimate the power of social media in this case. I would just about hesitate that social media and pundits would just about give John Campbell blanket coverage, even though the budget is, something that's probably more concern, but I think they're going to get more attention than they probably anticipated, regardless of when they announce it. But yeah, it was a pretty cynical sort of thing to do. It was on Radio Live's Twitter account. It was announced at exactly 2 p.m. So.
Yeah, certainly my Twitter feed is full of mainly Campbell Live-related outbursts rather than stuff to do with the budget. I mean, presumably that'll settle down in the next few hours. But yeah, so what else do we know about what's happening, Campbell? It's only the replacement show is only going to be for 4 nights a week, and on for 7 p.m. Friday slot, they're going to be developing a new entertainment show, which will fit in with TV3's successful Friday night comedy and entertainment block.
Well, we know that he was actually offered to be on this new show that was going to have 2 co-hosts, and he declined to join that. And I was just speaking to Brian Edwards before, and he told me that John Campbell's the type of journalist where he'll he's a sole performer basically. He's not suited to co-hosting a program. He needs to be the single person in the hot seat. And he's also, what he said was a change agent, a very much a public advocacy journalist. And I don't know what kind of format this new show will have, but I would hazard a guess that it would be something of akin to 7 Sharp. Yeah, do you reckon it'll be something like that?
Well, certainly in the statements that MediaWorks made in announcing John Campbell's decision to leave the show and the fact that a new show is going to be created within 6 to 8 weeks, apparently. They talked about the fact that the review clearly shows current affairs as our best option at 7 p.m. However, what would be most relevant to our audience at 7 p.m. While being current affairs would not be Campbell Live as we know it. So I think you're right, Campbell, in that there will be I guess the only way to describe it is a dumbing down of the format, and one that will be conform more to Prime Minister John Key's analysis of the purpose of the show is to entertain rather than inform.
Yeah, we'll have we'll have almost identical sort of shows, I would imagine. It's sort of struggle to pick some people off the top of your head that could do some things that would be similar to 7 Sharp, although MediaWorks has an abundance of journalists that love to entertain. The first person that actually comes to mind for me would be whether Paul Henry has been lined up for that slot, because as many people have sort of observed, his talent is sort of, it's not wasted as such, but sort of underutilized, being in the mornings sometimes, because he's a person who draws in ratings. And I've had a couple of advertisers tell me that they would, they were theorising that Paul Henry might be the one to take that 7 p.m. slot. But I mean, I don't think he could do that as well as the radio, as well as the morning show.
Yeah, I mean that would require a huge amount of stamina, and but also you would think that Paul Henry and Mike Hosking on 7 Sharp at the same time were kind of individuals who speak to a similar kind of audience and have a similar kind of personality. And how similar do you want your show that's going head to head with the competition to be?
Yeah, they it's a lot of the pundits out there on Twitter and the Twitterati would complain that there's too much right-wing coverage in that when you've got Mike Hosking and Paul Henry opposite each other on two different media outlets. But yeah, it just seems like what we've got is it's six more weeks of Campbell Live, so we've got quite a time to wait. Oh, not actually that long, to be honest, until we get a sort of framework as to what this new show is going to be.
And I guess one thing, Campbell, that would be interesting to watch if there are any legal proceedings arising from this decision to knock Campbell Live on the head and Mr. Campbell's decision to leave MediaWorks. I mean, there has been speculation that John Campbell would have grounds for arguing constructive dismissal, with the idea that the fate of his show was in fact predetermined, although he had been offered a co-host role on this new show, according to the statement by Mark, Group CEO of MediaWorks, Mark Weldon, this afternoon, that he was offered a 3-year contract as a co-host, but he did not sign it. Oh, sorry, hang on. Look, I better correct that. Mr. Weldon said, I offered John a 3-year contract, which he did not sign in November last year, though there is no clue as to what the contents of that contract was, but within the context of this wider announcement, it does suggest that he was possibly offered a co-host role. I mean, Mr. Campbell started at 3 News as a co-host with Carol Hirschfeld, but yeah, that was over 10 years ago now, and it would be presumably a huge backward step career-wise to take a dual role when you've soloed for so long.
Yeah, well, there's when I was speaking to media commentator Brian Edwards, he thought that the most likely place that John Campbell would head off to would be Radio New Zealand, because he said commercial radio is not suited to John Campbell's sort of public advocacy sort of style, and TVNZ is full up on the tabloid sort of style of things. And he's a solo sort of journalist, so there's not much room for him to move around there. So it seems like Radio New Zealand would probably be one of his best options, and we do know that Carol Hirschfeld has recently sort of shuffled a few things around there in the main newsroom, so there could possibly be some space for him there.
Indeed, and just go back to the potential for legal proceedings as a result of this decision. I would have thought a key aspect of that would be the fact that MediaWorks chose to take a 3-year contract with Campbell Live's principal sponsor, Mazda, rather than the year-long contract that Mazda was seeking, which again does suggest that the fate of Campbell Live had been decided quite some time before the review was announced in April. Anyway, so there's more to the story, despite this significant development, and we will continue following it closely, Campbell.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
In results news, DNZ Property Fund, the 6th biggest property stock on the NZX50 index by market capitalisation, posted a 66% gain in annual profit as it benefited from its property divestment plan, selling 5 properties and boosting the value of its remaining assets, and costs fell. The Auckland-based company said in a statement net profit rose to $68.8 million or 23.14 cents per share in the 12 months ended March 31st from $41.6 million or 14.47 cents per share in the year earlier period. Net rental income was little changed at $57 million, while corporate expenses fell 32% to $6.1 million, and finance expenses declined 1.9% to $13 million. Chief Executive Peter Alexander joined the company in December 2013 with the aim of restructuring the property investor to boost returns. In the past year, DNZ sold $32 million of assets as part of a plan to divest $80 million of property. The remaining 41 urban commercial office, retail and industrial properties increased 5.1% in value over the period to $872.4 million. Mr. Alexander said, "We will continue our targeted divestment program, which together with the flexibility and capacity in our balance sheet will enhance our performance and provide better returns in accordance with our strategy." DNZ, which is targeting 2.5% minimum annual dividend growth, will pay a 3.125 cents per share dividend on June 19, taking its annual dividend to 10.25 cents per share from 9 the year earlier. It raised its guidance for the 2015 annual dividend on April 23rd, saying it would be no less than 10 cents per share, up from an earlier forecast of 9.5. It forecast a dividend of at least 10.5 cents per share for 2016. Shares in DNZ last traded at $2 and have gained 4.7% so far this year. In the last year, the company's occupancy rate slipped to 96.6% from 99.5% the year earlier, while its weighted average lease term fell to 5.1 years from 5.5. DNZ said its Northwest Shopping Centre development at Auckland, scheduled for completion in October, had 100 tenancies confirmed as of March 31st, with construction 70% completed. The completion of the centre will be a key activity in the coming year and will have a very positive effect on earnings growth. Mr. Alexander didn't provide further details. The company said it expects to complete a review of redevelopment options for its Johnsonville shopping centre in Wellington by late 2015. In the 2014 financial year, the company wrote down the Johnsonville centre by $3.2 million as a delay in construction pushed costs up beyond what the finished project would be worth. In Forex news, Napier is the epicentre of online currency trading in New Zealand, with 9 of the 23 firms axed from the financial services provider register apparently based in the East Coast city. 8 of them appear to occupy the same building at 1 Dickens Street. The Financial Markets Authority on Tuesday announced it had removed 23 firms from the register this year because of concerns they were overseas businesses trying to piggyback on New Zealand's clean reputation. The regulator is empowered to order the removal of firms from the register if it's likely they're giving a false or misleading impression about the extent to which they are regulated in New Zealand. FMA General Counsel Liam Mason said, "We are aware of instances where the FSPR is not being used for its intended purpose. This is taking advantage of New Zealand's good reputation for being a well-regulated jurisdiction and a good place to do business." A list of 23 names provided to NBR reveals at least 17 are online currency brokers. Most have only one overseas director, typically from the Middle East or China. Websites belonging to those companies showed at least 15 claimed to have a place of business in New Zealand, with 9 in Napier, 2 in Auckland and 2 at the same address in Christchurch. 2 of the companies with contact addresses at 1 Dickens Street in Napier, Durbivy Limited and Global Prime Partners Limited, also had a New Zealand-based director, Michael Reps. NBR asked Mr. Reps a series of questions about the FMA's action. In an email, he said he would answer the questions, but only if the NBR agreed to publish his answers unedited and in full. NBR did not agree to that condition, so cannot publish his responses.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.